Just on the Hong Kong story, it's getting more and more troubling, more and more disruptive. Hong Kong has fallen now into a technical recession. But also the peg. At one point, it was really only the likes of Kyle Bass that was saying that the peg could actually drop, the peg versus the US dollar. I'm looking here at a chart in the Bloomberg, and I'm curious, is it more likely now that we might see the Hong Kong peg go away?
The short answer is no.
Yeah.
There are a lot of things going on in Hong Kong that I don't know will happen, but the one thing I'm absolutely sure of is that the Hong Kong peg will remain in place. It's ironclad. It's made to withstand much worse than it's seeing now. It survived the Asian crisis back in 97, 98, various crises throughout the decades. It's not to say there's not going to be pressure, but what we're seeing recently, there's been a rise in local Hong Kong HIBOR rates. Liquidity is tightening in Hong Kong, and that's the way the system works. As those rates rise, the Hong Kong dollar will be supported. And so there'll be a lot of volatility going into year end, I suspect. But for now, I'm say all clear on the Hong Kong dollar.
How do you forecast what's going to happen with Asian currencies in the next 3 to 6 months, given the amount of uncertainty there is regarding trade, and also Hong Kong, which may not affect the Hong Kong dollar, but surely has some kind of an effect on other Asian currencies?
No, it's very interesting. My take on the U.S. stance is that Hong Kong is an issue, obviously, but they're trying to separate from the trade issue. These are two separate issues. You also have the Muslim Uyghur issue as well in Western China. But I think these are all separate issues that they don't want to kind of muddy the waters. To me, I think right now that the U.S. is focused, the U.S. administration is focused purely on getting a phase one deal done. That would be very positive for EM. I think that's what really has been priced in. We've had some fits and starts. But if you look at what the asset markets in EM are telling you, a deal has been priced in that will actually remove tariffs. Mm-hmm. If we get something less than that, then I think we're going to get into another selling stage. But that's what's priced in. I think that's reasonable. The things have changed. The electoral calendar has changed. Mr. Trump is under a lot of domestic pressure. I think China realizes this, and they really feel they have the upper hand, and they're pushing. So Mr. Trump will be pushing back. What I think is very interesting is that he's really, if you think about his rage tweets, have pretty much just dropped off. I think he realizes he's in a very much different game than he was, say, 6 months ago.
If we don't get a phase one deal by the end of the fourth quarter, do we need to put the Fed back in play?
Well, yes. Right now, I believe the Fed sort of eased off the gas pedal for two reasons. The trade tensions who had been building up over the summer had eased over the last several weeks, and the risks of a hard Brexit have been significantly lowered. So I think that's why the Fed felt comfortable saying, okay, look, we're giving you three cuts worth 75 basis points. We're going to stop right now until we see what I think, quote unquote, a material reassessment of the circumstances. Yes, a re-intensification of the trade war would certainly count as that. That's not my base case. I really do think we'll get some sort of phase one deal done in Q4. But absolutely, if that changes, that would certainly count as a material reassessment. The Fed will have to start thinking about, or the market will have to start thinking about the Fed cutting rates again in early 2020. For now, though, you look at the data, the Q4, we're running about 1% growth, in sort of the New York and Atlanta Fed models. Half the 2% that we saw in Q3, but, it's still far from recession. I'm looking at this as a slowdown that will recover. But again, the resolution of this trade deal is a big part of this puzzle.